I thought it might be helpful if we broke this recording into two segments. Remember that a moment ago, I indicated that we would look at a sample cash flow projection. And we'll look at this by looking at the income statement and balance sheets for a sample company, BBSJH LLC, an enterprise solutions consultancy formed by graduates of Westminster's Bill and Vive Gore School of Business. The company was put together in 2018 and had modest cash flow growth through 2024. Like many companies, it struggled during the COVID-led economic shock of 2021, but it recovered nicely. So here we see the income statement for 2020 through 2024. And we can see that the company had net income of $259 at the end of 2020, $70 at 21, $225, 22, $768 in 23, and $1,075 in 2024. Now, you might want to think about these as being dollars multiplied by 1,000. So this would be 259,000, 70,000, 225,000, 768,000, and 1,075,000. I will discuss the numbers throughout the video as though they were dollars, but more realistically, these would probably be in thousands of dollars. Well, we can look then at the historical balance sheet at the same time. These numbers, using normal cash flow modeling or financial modeling convention, are such that any number in blue has been given, any number in black has been calculated, estimated, or constructed using some kind of a function. So all of the numbers in blue are historical, and we can replicate easily the numbers in black by summations, cell references, and such, but you would know how to do that. Same thing on the balance sheet. All the numbers in blue are given to us. All the numbers in black are calculated. And in this case, because it's an income statement and a balance sheet combination, the numbers in black are simply summations of some of the numbers in blue and numbers put together in the normal convention of an income statement and a balance sheet. But we can see all of these for 2020 through 2024, and we can use the historical values to find trends and as a launching pad, if necessary, to build future values from. When I talk about trends, we can look at the change in revenue, and we can say that there is from one year to the next some average annual percentage change or some periodic percentage change. We might have to decide whether or not that continues on into our future, or if there are some other dynamics of change present. We can look at the cost of goods sold, and we can identify what these cost of goods sold represent in terms of the percentage of revenue for any given year. And maybe we'll take an average of those as we forecast into the future, or maybe we believe there's some other dynamic at play. And we can do the exact same thing with wages, general and administrative expenses, sales and marketing, rent, depreciation, etc., just as we talked about in the prior video. So when we do this, we're going to have to think about distributions and other changes that we would consider. So in this case, as we're working on this sample, I indicated that the owners had taken a very modest income through 2024, but they're planning to distribute $500, 500,000, if you will, of the firm's cash flow to equity stakeholders in 2025, with plans to increase that as annual cash flows permit. We also are seeing that the firm expects changes in revenues, cost of goods sold, net working capital, operating expenses, gross fixed assets, long-term debt, and others as might be seen or can be seen in the following assumptions. And those assumptions were based upon not only looking at some historical patterns, but looking at owners and managers' plans, economic conditions, etc. Remember that every line on the income statement and the balance sheet must have a line covering it with an assumption, except for totals, subtotals, and accumulated retained earnings and accumulated depreciation and cash. Let me say this again. If we are now looking at creating assumptions that will help us look at the dynamics of change and the nominal growth in the income statement and balance sheet for the future years that we're forecasting, we need to have some kind of an assumption that motivates the changes in those numbers from one year to the next. Sometimes that assumption is going to be that various expenses will change along with the rate of change of revenue. Sometimes we're going to have to think about these changing with some constant rate of change. There's going to be different influences on the different elements on the income statement and the balance sheet that result in these changes. But every line on the income statement and balance sheet, other than totals, subtotals, accumulated retained earnings and depreciation and cash, are going to have some line of assumption to cover the dynamics of change. Every assumption needs a line, and every line needs to be covered by an assumption on the projected balance sheet or income statement, or the balance sheet will not balance to cash. Well, as we look at this further, we can look at what some of those assumptions might be. Here we've gone ahead and taken a look at the line items from the balance sheet and the income statement. And just as I indicated, is we now look at all of these line items and now go ahead and put those on an assumptions table. We can put together an assumption to cover every line item. Here we have an assumption for revenue growth at 10%. So it's going to grow at the rate of 10% in 25, 10% in 26, 8% in 27, 6% in 28, and 2% in 29. That's our assumption. We're forecasting this. We believe that cost of goods sold has a forecast ratio of 36%. So if we have identified what the expected revenue is for 2025, by having applied a 10% growth from the 2024 revenue line, and if we now apply 36% factor to that, we now have estimated cost of goods sold for 2025. With our wages and benefits, we're making an assumption that there's a percent change in our wages and benefits of 5% each year. That triangle is referred to as a delta, and delta means change. So this is percent change in wages and benefits. We're believing that once again, our general and administrative expenses and our sales and marketing expenses are moving forward at the same rate of growth as revenue. But in this case, G&A is 11% of revenue for 2025 and 9% of revenue, and sales and marketing is 9% of revenue for 2025. We believe that rent's going to expand at 5% a year. That's probably what our lease contract says. And it appears as though we have some information about our accumulated fixed assets, our gross fixed assets, sufficient to result in a depreciation expense in 2025 of $260. And that's increasing a little bit each year to $300, $325, $350, and then finally $400. We see some interest expense, and we're seeing that it's $150. And until we decide that we're going to change any of our long-term debt, then maybe that interest expense remains constant. And then we also have our state and federal income tax rate at 26%. We're making an assumption that remains constant. Now, I said a few minutes ago that we'll assume that the changes in any of our accounts receivable, accounts payable, credit card, inventory, and all of those conspire to create net working capital, by the way, as well as our gross fixed assets and our other capital elements are going to be changing in the future. We believe that our inventory, accounts receivable, payable, and credit card balances will all be growing at the same rate of revenue. So as you see here, I've got 10% for each of these first four net working capital categories for 2025, which is the rate of growth of revenue for 2025. I then replicate the rate of growth of revenue for these same items in 2026, 27, 28, and 29. I've gone ahead and made some assumptions about changes in gross fixed assets, so operating assets, long-term debt, paid-in capital, and distributions, now not as percentages of revenue and not as some dynamic of change by some percentage rate, but as actual dollar amounts. So in this case, I'm saying that for 2025, we're not going to be buying any additional gross fixed assets. In 2026, we're going to purchase an additional $300 in gross fixed assets. 2027, we'll purchase 400 and so on. In 2025, we're looking at reducing long-term debt by $100. 2026 by $200 and so on. We're saying we don't expect to receive any additional equity capital from our equity investors, so that's going to remain at zero. And we're saying that in 2025, we expect our dividends or distributions to equity stakeholders to be $500. That'll rise to $600, and then $700, $800, and $1,000, presuming that we have cash flow to support this as we move from 2025 through 2029. Well, if we look at applying these forecast values, these percentages, these dynamics of change, and we'll apply them to the income statement balances or values that we had to begin with, our historical values, these then let us estimate what our revenue, cost of goods sold, and so on are for 2025, 26, 27, 28, and 29. All I did to get this revenue number for any given year was I used the percent change in revenue represented in our assumptions table. All I did to get the cost of goods sold number for each year was to apply the forecast ratio for cost of goods sold for that year against that year's revenue. And that gave me the forecast value for cost of goods sold. And I did something similar then with the wages and benefits, general administrative, sales and marketing, rent, etc. I applied the dynamic of change represented in our assumptions table to each line of the income statement, other than subtotals like gross profit, or like subtotal operating expense, or EBIT, or taxable income, or net income. Those are simply subtotals. But to find the wages and benefits, the cost of goods sold, the revenues, sales and marketing, interest paid, all of those required that I apply the dynamics of change or the nominal values or whatever I had on my assumptions table that covered that item. So every line on the income statement covered by a line of assumptions. Similarly, every line on the balance sheet covered by some kind of an assumption. And in this case, I'm showing you both the historical balance sheet as well as the estimated future forecasts. I didn't do that for the income statement, but I did for the balance sheet. And you'll see how the balance sheet develops having applied those various assumptions. Now, again, we have in normal convention of how you construct a financial model, we have put all of our given values in blue. They're given because in this case, these are for 2020, 21, 22, 23, and 24. We didn't have to estimate those. We know them by looking at the income statements and the balance sheets for those years. But those are the given values for cash, inventory, accounts receivable. And we have then the subtotal for current assets, given values for the gross fixed assets and accumulated depreciation, subtotal for net fixed assets, subtotal for total assets. So when we look at the assumptions table again, we're going to be looking at some assumption for inventory, accounts receivable, and gross fixed assets and depreciation. We'll look at assumptions for accounts payable and credit cards, but we won't have any assumptions for subtotals. We won't have any assumptions for totals. We won't have any assumptions for accumulated retained earnings, because those are all subtotals. And if you're curious as to how accumulated retained earnings is a subtotal, well, it equals for any given year the prior year's accumulated balance plus that year's value. So if I'm looking at 2025's accumulated retained earnings of 4,130, I would take the 2024 accumulated balance of 3,338. I would add to it then the 2025 depreciation expense of 260. And that would then give me the accumulated retained earnings of 4,130. I'll do the same thing for each year thereafter. That gives me this accumulated balance that I'm looking at. The subtotal category here is a subtotal for owner's equity. And then we total liabilities and owner's equity to equal the final balance at the bottom. And notice the total assets for each year equal total liabilities for each year. So projecting the cash flow statement is doing nothing but taking items from the income statement and the balance sheet in much the fashion that I walked through in some of the prior slides for you. Now let's look at that forecasted cash flow statement. We first look at cash flow from operations, where for any given year, I take a look at the net income for that year. I add back to it depreciation and amortization. I subtract from it any increases in inventory. If these had been decreases in inventory, we would have added them. I subtract any increases in accounts receivable. Had these been decreases, we would have added those. I add increases to accounts payable, and I add increases for credit cards. And then I sum those all up in just this column. I go ahead and take any new purchases for gross fixed operating assets, and I would subtract those new purchases. Just as I would add if amounts here if we were selling gross fixed operating assets. And together those become our cash flow from investing. And then if we borrowed more money, then that's a positive to cash flow. And if we've paid off debt, that's a negative to cash flow. So here we see negative values of 100, 200, and so on. That's because the company is paying off debt. How do we know the company's paying off debt? Well, we can go back and we can look at the assumptions. And notice that in our assumed values, in our table, we said we were going to pay off $100 of debt in 2025, 226, 227. We also said that in 2025, we're going to pay off or pay $500 to stakeholders, equity stakeholders, 600 the next year, 700 the next year, and so on. How do we see those represented in our forecasted cash flows? We see the paying off of debt as negative values, just as we see the paying of dividends and distributions as negative values. I didn't show them as negative values in the assumptions. I made that conversion when I did the cash flow table or cash flow statement itself. In this case, we're not taking on any new equity investment from new or existing investors, so those are all zeros. But had we brought in, say, another $1,000 in equity investment in 2025, we would have had a $1,000 value here as a positive, because bringing in equity investment is bringing in cash to the company. That's a positive. In this case, we didn't bring any in, so we have cash flow from financing. This is simply the sum of whatever our cash flow elements that combined for that are. And in this case, we can take the cash flow from operations, cash flow from investing, cash flow from financing for any given year, and together that equals the cash flow for that same year. If we add that cash flow to the beginning cash balance for that year, which is the same as the ending cash balance for the prior year, we then end up with the ending cash balance for that particular year. So now what? Well, the whole purpose to identify a cash flow projection is to identify what surplus or shortages of cash we're going to have. If we create surpluses of cash, we can choose to acquire new operating investments, or maybe we can pay off debt, or maybe we can go ahead and provide distributions or dividends to our equity stakeholders. If we have shortages of cash, then we're going to either have to scrutinize the assumptions and see what resulted in those shortages and see if we can improve on those, or we're going to have to think about raising new cash. If we have shortages in cash, we can borrow money from the bank, or we can go to equity stakeholders and bring on new equity capital.